Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion, the CEO and founder of Flying V Group, Deep Knowledge Investing's marketing partner. Robb, how was your week?
Week has been pretty wild actually here in Southern California. I was met with all of my East Coast buddies telling me I don't know anything about real weather, yet at the same time, we are getting absolutely destroyed because California is not built for even an inch of rain. And so it is raining and it is raining hard, at least relatively for me, but I am surviving and hanging in there.
You know, Rob, by the time I was 7 years old, I grew up in Michigan and I was shoveling snow in the driveway that was like chest high for me. So I have so much sympathy for you. It's terrible that you got rained on. I don't.
I told them, I said, call me whatever you want. At least I still live in California, and most of the time we've got the great weather. So,
Yeah.
yeah, but it's been interesting. Yeah, a lot of mudslides, flooding, just because again, streets are not built for this. A lot of people without power, but we're hanging in, and it's been fine. We'll be all right.
All right, good. Glad you guys are okay.
Yeah. This week, Gary, so we got the surprise hire for longer issue. We're going to jump into a lot of different topics as we do on this five things. We're talking about Jerome Powell again and the Federal Reserve in doing what they said they do, or maybe the opposite. We'll talk about that. We're getting into manufacturing PMI. Got some more reporting on DKI stock pick Coursera, announced earnings last week. And then we'll talk a little bit of Saudi Arabia oil as well. Ready to go, Gary?
Let's go.
All
What's
right.
first?
Point number one, the Fed shocks the market with consistent behavior. Great headline.
Yes. Yeah, exactly. I was shocked that the market was shocked. So, for the people who are watching this who maybe aren't, buried in finance every day, the Federal Reserve meets, I think it's 10 times a year. And at those meetings, they will make a decision about whether they're going to change the Fed funds rate, which is when you talk about the Fed tightening or loosening, higher rates, lower rates. These are the meetings where those decisions are made. And last week, they concluded their January meeting, and the Federal Reserve sent the market plummeting by announcing that they were not changing rates and they were unlikely to do so at the next meeting, which will be in March. And
Right.
so, the question is, why was everybody shocked? The fact is, these guys have told you in crystal clear language, that they were going to be tighter for longer. The numbers they look at the CPI, the consumer price index, the PPI, the producer price index, the PPE. There are all these indices they look at. And the truth is that inflation, even the way our government manipulates the numbers to make inflation seem lower than it is, lower than what you're experiencing, um, it's still well above their 2% target, which, by the way, is 2% above where that target should be. And we just saw that again, manufactured GDP print of 3.3%. People were looking for 2%. We just got, again, faked employment numbers. We've talked about this in recent weeks, but with 9 million jobs outstanding, wages up, and an unemployment rate of 3.7%, which is still very low. To us at Deep Knowledge Investing, it seemed obvious that the Fed was not about to raise rates. Now, the thing that Powell and the Fed did, which I think really surprised nobody, was they took the tightening language out of the press release. There's been language in the press release for the last couple of years saying that they'll be data driven. They'll look at the data that comes in and figure out what, if any, firming needs to take place, which is their way of saying, hey, we might raise rates again. Now they've taken that language out, and at DKI, we've told our subscribers months ago, we've hit the terminal rate, which is the finance way of simply saying it's the highest rate that the Federal Reserve will be at in this particular cycle. Not the highest in your life, but just the highest for now. And the next move is almost certainly going to be a rate reduction. But why the market was shocked when the Federal Reserve said, yeah, we're going to hold where we are for a few months while we still try to get inflation down, and Congress is spending like crazy and manufacturing these numbers. That to me was interesting. I think they've been consistent in their language, with the exception of some comments that Powell made a couple months ago, which did surprise people because you got very dovish, meaning favoring lower rates at one meeting. But this to us wasn't a surprise, but it sent the market down a couple percent that day.
Yeah, and as you mentioned, election year, Congress not going to be cutting spending in an election year, whereas you said, or in a non-election year as well. So very interesting coming out of the Fed.
Yeah, there's no question on this. And this is, I think, something Rob, you and I have talked about in other video versions of the five things. There is a really interesting policy battle going on right now between the Federal Reserve on one hand, and those guys want to keep rates high-ish. They're not really high, but they want to bring inflation down. On the other side of this fight is the US Congress that is spending like crazy, and the Treasury, which is monetizing things, which is basically creating dollar currency units to pay for all of the spending. And all of that activity is inflationary. And so what we're going to have, particularly in an election year, is no cuts in spending. And so they're going to spend in a way that's going to create more inflation. And so, I think part of what the Fed is trying to do is hold on to the gains they've made against inflation. It has come down, but it's still too high.
Moving to point two, we're going to talk about the ISM Institute for Supply Management. They released their January Purchasing Managers Index. The ISM PMI is down and better than actually expected.
Right. So the ISM is the Institute for Supply Management, and the PMI is the Purchasing Managers Index. Okay. So one of the things we've been talking about the last few weeks is this mix between the upstream and the downstream inflation indexes and manufacturing indexes. And what we've seen is that the consumer price index is still pretty high. It's still too high. Consumers are spending a lot, and they're spending a lot on services, and services prices are up a lot. But we've noted in recent weeks that a lot of the manufacturing indexes have been down. And we think what's happening is companies are saying, oh no, the consumer's spending a lot today, but we're worried about a future recession. And so they're throttling back their production of goods and trying to, keep pricing where it is and not be overproducing into an expected recession. And that's what we've seen a lot lately. And, I think just last week we were talking about manufacturing indexes that were horrible. The PMI from last week was really interesting. So the overall index came in at 49.1. Anything under 50 indicates contraction. So you think, okay, wait, that's more decreases. But here's where it got interesting. The prior month was 47.1. People were expecting 47.2. Doesn't sound like a big difference, but when the market's expecting 47 and they get 49, that's actually, it's better than what they were expecting. The other thing is the new orders index was 52.5. And so again, anything over 50 indicates expansion. And so for new orders, it actually looks like this stuff is starting up again, and the economy is just refusing to roll over. Now, the one caveat that we have here is the prices index was 52.9. Again, everything over 50 means getting bigger, versus 45.2 last month. That's a huge change. In 1 month to go from 45 to 53, that is a huge change in a month. And so here's where we are right now. This piece of data, which contradicts the data that we've been seeing the last few weeks, we keep talking about inconsistent data. So if you guys want to go back and see, our 5 things video from last week or the week before, you say, wait a minute, this is a contradiction. Yes, the data is changing every week. But basically what this is telling us is that manufacturers are seeing more new orders at higher prices. So, get ready for the consumer to keep spending and for inflation to continue to be a problem. And I don't know for sure, but I think it's a really good bet that Jerome Powell and the governors of the Federal Reserve had seen this data when they said, yeah, we're not going to lower rates yet. They want to hold on to where they are right now. They believe that the current Fed funds rate is restrictive, which is the fancy finance way of saying high enough that it should bring inflation down. They're looking at this, wait, new orders, higher prices. You know what? We're just going to stay right here where we are and not change this at the moment. Again, I'm not in the room with them, but it's a pretty good bet they'd seen this data when they decided to say, yeah, don't count on a reduction in interest rates in the next couple of months.
Yep. Higher for longer is definitely the camp.
Yeah.
Point number 3, we had jobs report come out Friday. I know Twitter and X was calling it the hashtag Biden boom. The employment market remains red hot. We know what that means is point number 3.
Yeah. So let's cut to the end, right? What does a red hot employment number mean? It means higher for longer, right? Again, it's a good bet the Federal Reserve had this data when they said we're not going to lower rates.
Right.
So a hot employment market, lots of jobs, higher wages, high employment, that's the kind of thing that will make the Federal Reserve keep rates where they are instead of lowering like people are expecting. But here's the key thing. These numbers are weapons grade balonium, right? The first of all, the numbers are manufactured. I think, I saw somewhere they're getting responses on the employment stuff from about 30 to 40% of the businesses that they survey. So they're making up 70% of the numbers. 70% of what you see is an estimate. And so when they're saying, hey, this is, great for the administration, this is great for the White House. Well, Rob, if I could make up whatever numbers I wanted, like I'd love to make up my investment returns and tell, but yeah, we make 100% a year. We don't, right? But if I could just make up numbers and then claim it as a win, I would love to do that. We can't do that in finance. Or if you do, you go to jail. We've seen people do that. So let's talk about how they're faking some of these numbers. Right. The job openings report was something like 9 million jobs. It ticked back up over 9 million. That's a huge number. And yeah, it's down from 12 million a year ago or 2 years ago. But it's still a huge number. But one of the ways that is getting faked is a lot of those jobs aren't real. And, for the people listening to this, for anyone who's applied to a job in the last couple of years, who's had the experience of you've applied for a job and like nothing happens. There's no interview. They're not interviewing it. You look a year later, that job is still listed, right? It's not a real job. They do that one to make it look like the business is growing, to make it look like activity. They also do it to placate their existing employees. So you've had people who are overworked and saying, hey, we need help. And managers are saying, okay, don't worry. We're going to list the job. We're going to fill it. Don't quit. Don't be upset. Help is coming. Help isn't coming. Right. So that's one way that they fake this. The other thing that we saw was a massive increase in non-farm payroll. It was, wait, let me get the number, 353,000 jobs added in the month of January, way above expectations of 185,000. Let's talk about how they do that. First of all, it's not 353,000 jobs. Employment from December to January drops, right? We all know people hire for the holidays. So how do we have jobs going up from December into January? That never happens. The answer is jobs didn't go up. They seasonally adjust these things, right? So you always have fewer people employed in January than December. That's just the seasonal nature of the business, of everybody's business. But what happens is they seasonally adjust these numbers. So basically it's not 350,000 more people employed. It's the government putting a multiplier on the number of new jobs. And so that's dishonest, but it is the way that it's done. Here's the other thing that's happening with that. Full-time employment is dropping. And so what's happening is if somebody loses their full-time job and then they get 2 part-time jobs to try to make ends meet, they're counting that as 2 jobs. Right. This is not a sign of a healthy economy. And so what we're seeing, Rob, you were talking about people saying, hey, this is a win for the administration. It's a win for the White House. What we're seeing are headline numbers that deliver on a particular narrative. And then when if you're like me and you read the release or you go through the tables on, page 19 of these PDFs, right? Most people don't do that. People in my business do. But when you start to take this apart, and look into the details, you realize, wait a minute, this is not nearly as good as they make it out to be. It's
Right.
the reality is not as good as the headline numbers. And that doesn't make its way into the newspaper headlines.
And that's why you're great, Gary, reading page 19 of the jobs report to bring us that incredible information. So, but
Yes,
yeah,
for
I think you're right. There's a lot of narratives out there that do just look at that absolute number and have no idea what is actually baked into that number.
that's right. And listen, I get it. Most people don't want to read, these lengthy economics reports and start going through the numbers, and I get it. If you don't want to do that and the idea of doing that bores you out of your mind, subscribe to Deep Knowledge Investing. I'll do it for you, right?
There
I
you
will
go.
be bored on your behalf.
Love it. Point 4, we're talking oil. Saudi Arabia stops oil capacity expansion.
Yeah. So the Saudis are still, a gigantic oil producer, and they produce about 12 million barrels a day. Worldwide crude oil production right now is right around 95 million barrels a day, give or take a little bit. And so, the Saudis are, like 14% of that. It's a big number. And they had been investing to increase the maximum sustainable capacity from 12 million to 13 million barrels. And last week, the Saudi government told Aramco, which is their national oil company, cut it out. Don't stop work. Don't spend to expand. We're keeping capacity at 12 million barrels a day. Now, it's really easy for people to say, okay, but is that really a big deal, right? You've got like 95 million barrels a day, and you're losing 1 million, but like, why is this a big deal? Who cares, right? It would be like, if somebody snuck into your refrigerator and took 1% of the milk you had in there. You're like, okay, well, I lost 1% of my milk. Is that a big deal? Well, on the milk, it's not a big deal, but here's why it is a big deal in the oil market. It's because oil gets priced at the margin, right? And so when you have a world that has increasing energy demands, and just think about this for a minute, right? And there is a straight line between energy usage and material quality of life. You have almost 3 billion people between China and India alone, right? 3 billion out of the 8 billion people on the planet who are saying, we do not want to live like this anymore. We want a higher quality of life. That means more energy usage. Right now, that's hydrocarbons, right? That's where we are until we get more nuclear plants set up, or until there's cold fusion, or a better answer than the current technology for things like windmills or solar panels, which are not effective baseload generation. Sorry, I'm not trying to tick off the environmentalists. This is just these are just the facts of what materials are energy dense and which ones aren't. And so you have a huge part of the planet that really wants to live a better life, and that means more energy usage. Today, that means more hydrocarbons. And so when you have increasing demand, but you don't have increasing supply, right, prices will adjust, and oil gets priced at the margin. Again, just a fancy way of saying it's the last barrel of oil, right? It's somebody saying, I really want this, I really need this, that changes the price of oil. So as crazy as it sounds, right, is losing one out of 95 million barrels of production a big, yeah, it actually is a big deal. And it's also a big deal when it's the Saudis. And the reason I point that out is for decades, they have been very sophisticated and intelligent at managing oil supply to keep prices within a certain range. That's the Saudis telling the world prices are not coming down below where they want it to be. And they definitely don't want pricing anywhere close to $60 a barrel. And the reason for that is that's kind of the price where it makes sense for US fracking operations to really come online, right? And so, sorry, I actually said that wrong. They don't want, when pricing gets above that too much, US fracking operations, the way I phrased it was wrong, have an incentive to come into the market. But
Sure.
it's the point of all this, and I think I've done a poor job explaining it, is that the Saudis are sophisticated when it comes to this stuff. And it's not just that you're losing that million barrels of capacity. That's them signaling to the world, we're going to keep oil prices high and we have the power to do it. And so here we are. So get ready for higher oil prices. For people who are annoyed at paying more for fuel oil to heat your home, or paying $4 or $5, or in California, $6 a gallon for gas, and if you're annoyed when you fill your tank, the best thing that we would recommend is own energy stocks, right?
Yep.
You can own oil production, oil transportation, uranium. We have a huge, I personally have huge energy exposure because I'm annoyed when I go to fill my car and it's expensive. I might as well sell myself the gas.
You took the question from me. I know DKI, large energy exposure in the portfolio. So I was going to ask about that, but you're a step ahead, Gary, as always.
Oh, it's I figured the question might be coming, but the point of all of this, right, is for the people listening to this who are saying, wait a minute, I don't want to deal with higher gas prices, higher oil prices, higher energy prices. It will affect your electric rates. The best thing to do is to own the stocks that are going to benefit from this. And so, yeah, your expenses are going to be higher. Your energy expenses will be higher over the next year. But you could make more than that in your portfolio and be able to afford it.
Great. Moving to point five, we're going to stay in the same kind of vein with DKI portfolio. We're talking Coursera now here. Coursera announced, I believe it was last Thursday, beats estimates and issues strong guidance moving forward.
Yeah. So a little history is important here. A year ago, Coursera gave guidance for 2023 that was horrendous. They indicated that their growth was slowing, that business was weak, and the stock just got crushed. It traded below $10. Um, and it was one of those things that you never want to take a loss, but if there's a problem with the business, you need to sell it or you're going to take a bigger loss. And so, there was a debate here at Deep Knowledge Investing. What do we do with the stock? And I had the opportunity at the time, a year ago, to talk to the company. And I said, guys, what's going on? Why did your guidance get so weak? Why is the growth rate coming down so rapidly? And the answer they gave me was, it's not. We were just being conservative. Right? They were issuing conservative guidance they didn't want to miss. And so they were setting the bar low, and they'd crashed the stock by setting the bar low. So we held on to it. Lots of Deep Knowledge Investing subscribers were buying in the, $9, $10, $12 range. And here's what happened. The company had given guidance, I think, for 14% growth, and actual results were up 21% for 2023. For the quarter, the company delivered revenue growth of 19%. Analysts were looking for 15%. These were solid beats. And then this time, Coursera gave, much better guidance for 2024. The guidance they gave was above, where the analyst estimates were for the year. So the analysts are going to have to take up their numbers on the stock. And basically, it's had a weak day or two. The stock has, but the stock has basically doubled off of the lows. And so holding it was the right move for for our subscribers who bought more. I'm glad they did. They've done really well. And the big difference here is, first of all, we're looking at a company with a great business model. Growth over the last 6 years has ranged from 21% to 59%, never lower. Right? That's a sign of a good business. One of the things that's hurt the stock is the competitors have been horrendous. Tutoring/cheating site Chegg has seen its stock get cut in half in the last year because of competition from AI. Coursera, and part of the issue is professors hate Chegg and they'll ban students for using it. It just has a bad reputation among educators. Coursera is benefiting from AI. There are a lot of people who want to learn to use it and are signing up for Coursera to learn to use AI better. Direct competitor to you has a horrible business model. These guys have a business model that relies on selling online education at the same six-figure prices that people pay for the on-campus experience. It's a bad business model. Their stock in the last year went from $13 to below $1. It got obliterated. Coursera, on the other hand, has been growing. The free cash flow was better than people thought, and this time they gave guidance that was better than what the analysts were expecting. So seems like they have things under control.
Yeah, I can comment on that too. I know we're actually going through onboarding with Coursera right now. Just from a upskill standpoint, right? You talk about AI and new technology in the market, right? There's very, very, very few areas in which you can educate employees, groups of employees, and especially when you talk at that enterprise level, that upskill of employees. So I've always been bullish just on Coursera, not from everything obviously you've said, but just from the model itself, being a business owner and seeing, hey, where I want to invest into our business as well. So just a little nugget there.
Rob, what kind of classes are your employees taking on Coursera?
Yeah, so I'd say that, things are shifting, right? From a traditional education university standpoint, you're obviously getting much more focus and emphasis on the digital aspect of marketing and advertising, right? Everything I learned in early 2011, I graduated, right? It was all traditional lines, right? Traditional thought, theory, etc. Definitely has shifted, but even now with the technology, when you talk about AI, you talk about search engine optimization, paid media buying on all your favorite platforms, Meta, Google Ads, etc. It's constantly changing, shifting, and adjusting. So a lot of those courses that are hands-on, working directly with those types of lanes of marketing, I know are a big piece of Coursera's business, and that's just one tiny example, right? You probably have that example across all different types of verticals and businesses. So, but yeah, that's our big focus, is really filling that gap that traditional education is just not going to give you at the end of the day.
That's a great point. There was one of the sell side analysts from Goldman Sachs sent the stock down. I think it was down like 8-10% at some point during a day because the Goldman Sachs analyst had said, we're downgrading all the education stocks because of AI.
Mhm.
And Coursera correctly responded saying, are you kidding? This is a huge opportunity for us. Yeah, some people will lose their jobs because of artificial intelligence, but more people want to know how to use it to keep their jobs,
No doubt. No
right?
doubt.
Or do
Yeah.
their jobs
Everything
better.
from efficiencies, doing their job better. Yeah, you better believe it. We've dove head first and we've seen noticeable gain. Yes, because of the AI, obviously, in terms of the platform, but more so because we encourage use, we're training on use, and now you're getting more out of those tools that are at their disposal.
Let me ask you one follow-up question about how you guys are using at Flying V, how you're using Coursera. How much are you paying to provide skills-based improvement and education for your employees versus how much would it cost you to hire somebody who already had that skill set?
Yeah. So basically they do it by a head count license seat, right? I think at the end of the day, we're around like $40-50 a user, absolutely unlimited access. From there, we're putting in guidelines, right? And that, hey, as a part of your job on a monthly basis, you got to complete one course, right? Or depending on the length of the course, right? It might be over a couple of months. So yeah, I mean, we're sitting at, I think, 10 license seats right out of the gate. $6,000 investment over the course of the year, and that's being applied all throughout the organization, and just really investing in our own business that's already been there and the people that have been with us, right? You're talking a multiple of 10x plus, right, to bring in, and I don't even think they would be able to cover the scope of the knowledge that you're being able to build, because you're building across 10 different individuals.
So it would cost you 10 times more to hire one person with the skill set that you're helping 10 people develop within the organization.
Exactly, yeah, and I think that 10 times is probably very, very conservative.
Yeah. So, if you want the case for Coursera, there it is, right? And that's why AI it's a threat to Chegg, but not to Coursera.
Great. Gary, thanks so much again for this week's 5 things. As we always mention, just to close up the end of the show, please jump on deepknowledgeinvesting.com. At least sign up at the minimum to be a free subscriber. You'll get updates and alerts on new content posted. There will be limitations to access. That's reserved for our premium subscribers. We have both a monthly option as well as a yearly option with some breaks. Really encourage you to check that out. Let us know if you have any questions. We'll continue working as hard as we can to provide you the best investment research insights. Gary, as always, thank you for doing such an incredible job in keeping the pulse on the markets for us. Any closing thoughts from you?
No, looking forward to seeing what's going to happen this week. And over the weekend, we'll write next week's 5 things and see you guys next week. Thanks for taking the time to watch us. We know your time is valuable. And Rob and I both appreciate it. Thanks for being here.
Thanks, everyone.